Hello and thank you for joining. We'll begin our webinar in about 2 minutes, so just hang tight and we'll get started shortly.
Welcome to everyone who has joined.
Welcome to Unit 21 State of Fraud and AML VIP Preview Webinar. I'm Jason Mikula, the publisher of FinTech Business Weekly newsletter. I'm joined today by Alex Fivasovich and Jeremy Baudret, and I'll be moderating today's conversation. FinTech Business Weekly is a once-a-week newsletter offering in-depth analysis on trends and stories in banking, fintech, and crypto. Common themes include banking as a service, embedded finance, compliance, regulation, BNPL, payments, identity, and more. And for those of you who aren't familiar, Unit 21 provides a risk and compliance infrastructure that allows companies to ingest any type of data for transaction monitoring needs without writing code. They also provide case management to streamline your operation work and automation for SAR and FinCEN filing. Now, our speakers. Alex, if you want to go ahead and introduce yourself.
Thank you, Jason. My name is Alex Fivasovich. I'm the head of fraud risk here at Unit 21. About 15 years of experience fighting fraud with traditional banking, did a lot of consulting, eventually transitioned to fintech. In my role with Unit 21, I work with our go-to-market team, with our product team and customer success team to making sure that we as a vendor provide the best fraud prevention strategies and tools to our customers. Great to be here.
Thank you, Alex. And Jeremy, would you like to say a few words?
Yeah, I'd really like to thank the hip New York hotel room for sponsoring the music at the beginning of the webinar. But my name is Jeremy Baudret. I am a ex-deputy AML or BSA officer and senior counsel at several different FIs before joining Unit 21. And now I am the strategic account manager here, where I'm working with traditional FIs like banks and credit unions. Very nice to be here.
Fantastic. Thank you, Jeremy. And thank you both for taking the time to join us today and share your expertise with our listeners around the world. We've got a great program lined up, and I'm looking forward to jumping in. A few quick housekeeping items before we begin. We're hoping for this to be an involved discussion, and we'd like to ask everyone who's listening and watching to submit any questions they'd like using the Q&A button at the bottom of your Zoom screen. This session will be recorded, and we'll be sending the recording along with a full copy of the report to everyone who's registered after the report publicly launches next week. And so without further ado, let's get started with an overview of the report. I'm really excited to dig into the findings from this report. But before we do that, Alex, can you provide a little context around the report and sort of who's answering some of the questions in it?
Yes, absolutely. So this is actually the second year we launched the report. And the purpose really is to share how risk and compliance professionals truly feel about the fight against fraud and money laundering, how they see the industry evolve, and how they, thinking about approaching the challenges in the near future. And to do so, we really ask those professionals a series of questions to better understand what points they want to alleviate, and the top processes they want to improve this year and the near future.
That's great. And can you tell us a little bit about who responded to the survey?
Yeah, so we see on the screen that from location perspective, we have about 76 of respondents coming from the US, 19% from EMEA, 4 from APAC, and 1% from LATAM. Job titles really go all across the board: managers, directors, analysts, and some C-suite responders as well. And from responsibilities, about 30% came from fraud and risk, 33% from AML and compliance, and 37% said that they're responsible for both. So we really feel that with this report, we have a good coverage of industry experts.
Thank you, Alex. Now let's get to the good stuff. Our first topic for the day will be about the top priorities for risk and compliance professionals according to the survey data. Now, according to the survey responses, the most significant priorities for risk and compliance professionals in the coming 12 months are: number one, adding automation to manual processes, with 71% indicating that's the top priority. Number two, the ability to respond to changing financial crime schemes or new regulations, with 65% indicating that response. And number three, improving efficiency and reducing the cost of fraud and compliance programs, nearly the same at 64% of respondents. Interestingly enough, adding automation was a trending topic throughout the report. Jeremy, what do you think about adding automation to manual processes is such a key focus area this year?
Yeah, I've always thought that automation is in actual practice and in theory works well for AML and fraud organizations. But I still think that some manual processes need to stay manual for managers to be able to have certain action events that will go through them. And I think from a regulator point of view, it makes a lot of sense that the business owns the risk and is able to apply risk-based approach. But then there's a lot of automation that can be done at an organization. It could be as simple as exporting an Excel document and converting it into a certain piece of data that is used on a frequent basis. Just by being able to automate that step instead of having to download the Excel document, uploading it to your database, formatting it to whatever your org's structure is, that process alone is something that is top of mind for a ops manager that might be working for an AML or fraud team to just simplify the process. But again, when budgets are tight and you want to remove levels of redundancy, and you want to keep employees happy, automation is always top of mind.
And what about you, Alex? What do you think that manual processes have become more of a hindrance to productivity?
I think, first of all, market conditions in a way pushing many financial institutions towards automation. I mean, we speak to risk leaders who had 15-20% of workforce reduction, but the KPIs remain the same. And they ask us, okay, how can I achieve the same goals with way less people than I had a month ago? And when we talk about automation, we usually say that you can achieve automation on several different levels in several different ways. But you really need to ask yourself, what is the end goal? What are you trying to automate? Is that team efficiency? Is that customer experience? Is that just reducing the cost of the program, like Jeremy said? You must prioritize based on your organization needs. And when you turn the process into automated, you need to make sure that, just like Jeremy said, you cannot just put it on autopilot and have nobody looking at it. You need to make sure that you're not creating any other gaps or exposing yourself to other risks just by having a process automated.
The ability to respond to changing financial crime schemes or new regulations came in second, with 65% of respondents saying this was an important item for them in the coming year. Alex, did that surprise you?
I mean, no, not really. Even based on the last year report, it was a main focus point for many risk and compliance people. At the end of the day, crime scheme evolves as technology evolves. And the regulator is usually 1 or 2 steps behind it. but the evolution of the financial industry is about how do we really leverage tech and use tech to give better access to financial products. But when we give access to financial products, we need to make sure that both the end users who will enjoy the access to the financial product and both the financial institution are kept safe.
What about you, Jeremy? Anything to add to those responses?
I still I think regulation is always a major concern for FIs, especially when it changes a process that has been around for decades. For instance, the CDD rule, it was and is still being argued because of the amount of time it would take for FIs to comply with the regulation. So changing what is known to an unknown is very difficult for a lot of teams, especially when they're ingrained in the type of way that they've done things, and it's gone fairly well for them as of now.
Mm-hmm. Makes sense. Based on the first priority of automating manual processes, it seems appropriate that the third highest ranked answer was improving efficiency and reducing the cost of fraud and compliance programs. Jeremy, what are some of the ways fraud and AML teams can achieve this objective?
Well, technology has made things much easier for FIs, but it's also made it significantly easier for criminals and fraudsters. In 1995, the first U.S. bank introduced the online account creation process. And imagine a world where a Gen Zer would now have to physically walk into a branch, open up a bank account. I think that would be probably riots in the streets, but automating the manual processes like ID verification, email address, and phone number risk scores have made FIs almost completely digital. Where there was a fraction at inception, now it's the inverse. And so having a system that streamlines workflows, increases productivity, and does so without adding personnel is an ideal situation for fraud and AML teams. So it's imperative for teams to trust the solution that they're using, but being able to optimize the tool, being able to really know how to use it is a great way to fight fraud and combat money laundering.
Alex, do you have anything to add there?
Yeah, I completely agree with Jeremy. I think, streamlining processes and automating routine tasks is really the right way to go. And at the end of the day, we are hiring such a wide range of professionals, and it's really up to us to dictate what are they doing with their time. If you're hiring a compliance or risk professional, and the only thing they do today, the day to day, is working on an Excel sheet or making sure the Excel sheet is right, instead of going deep dive into the really high risk issues that your financial institution is dealing with, it's not a good use of their time. So how do we really can help our organization to prevent fraud and to be compliant, and making sure that we're using those people that we hired in the best absolute way. But it also shows our stakeholders that we are serious about a long-term loyal relationship with our customers, our investors, and our partners, because we invest in compliance, we invest in risk, and we invest in solutions that make our organization better.
Thank you. I'd like to shift gears a bit and drill down into the main challenges facing today's risk and compliance teams. If there's one constant of the last several years in banking and fintech, it's change. The near manic environment of the early pandemic, powered by basically 0% interest rates, surging levels of venture capital, and plentiful government stimulus for both businesses and consumers, has left some in the industry with a bit of a hangover. But problems that may have been easier to ignore or just throw bodies at a few years ago, including in fraud and AML risk, those problems haven't gone anywhere. Jeremy, one of the biggest pain points regarding AML tech was that the software doesn't keep up with changing regulations and changing threats. In fact, 58% of respondents said they would change their vendor to keep up with changing compliance regulations. The same percentage of respondents also said they would change because they need to automate processes. Conversely, only 24% said they would change vendors if their agents were having a difficult time using the system. What do you think about that?
Well, the last major enhancement to the BSA happened after September 11th with the USA Patriot Act. And the world has changed a lot over the past 20 years. However, their AML and fraud solution hasn't. So in their world, cash and wire transfers are the high risk products, and ACH and checks are considered to be low risk, which I would say is probably wrong now. COVID forced a large amount of FIs, especially regional credit unions and banks, to bring their banking and products online. Most of them thought, well, we're a regional bank, we're going to be servicing our customers in this specific region, but they didn't realize that now they're borderless, or conceptually they're borderless, because they never thought of, no one's going to use a VPN to get into New Mexico and create an online account. So I mean, that is just very wrong type of thinking, but it was all guesswork at that point in time. And with the Anti-Money Laundering Act of 2020, it encourages banks to test and adopt innovative approaches to fighting financial crimes like AI and ML. And I think even though it's still very early in discussions, if you look at what's happening around the world in certain jurisdictions, they've allowed AI and ML to replace certain lines of defense and being able to actually take actionable events on alerts. I think America's far from going down that road, but at least there's some level of precedent being pushed out there. And FinCEN is recognizing that AI and ML can improve the way that financial crime professionals can either prevent fraudsters and other criminals.
Makes sense. I mean, on the fraud side, respondents were pretty much equally concerned with system scalability, access to advanced machine learning to help them prevent fraud in real time, and improve reporting and analytics. Why might scalability be an issue here?
So I think, our goal as a vendor, or, even as fraud prevention leaders, is to create the absolute best environment for our agents to make the best possible decision in the shortest amount of time. And that goal is nearly impossible to achieve if you have an in-house build or you're heavily reliant on engineering resources. As companies scale, also the customer is scaling. If you become digital and you allow more access to financial products to your customers, the behavior of the customer will change along the time. So, you might have rules that had a high fraud catch rate in the past that are no longer efficient. And basically what you need to do is you need to have a system in place that can meet those changes, the system that can help you fine-tune your strategy and over time make it more and more efficient. Managing rule sets is an ongoing process, and whenever a new rule is need to be implemented, most cases are an old rule need to be retired. And the more teams can automate rule management, and rule management is everything, is the analytics part, the rule creation part, the ongoing management of the rule, the retirement of the rule, the fine-tuning, the more efficient teams can be, and the more time they can spend on actually going and investigating higher risk cases and activity.
I mean, on that note, another key issue was regarding data integration. 55% of the respondents admitted that ease of integration, and particularly integrating new data sources, is difficult or requires too much support from engineering. Alex, why is this such a challenge for financial institutions to tackle?
Yeah, data integration is a huge pain. And I think realistically, there is no one fraud solution out there that can solve all your problems, right? I mean, we're seeing with very successful organizations that they usually have an infrastructure platform and maybe 3, 4, or 5, 6 point solutions that are specifically address the risk that they might see on their platform. And you must understand what data you need, at what point you need to use it, and how to access it, and how to make it usable for the agents. And chances are, the bigger your organization is, the harder for you to integrate those data points, because probably they are all siloed and not accessible by the team.
Is there something you'd recommend to companies that are experiencing these kinds of challenges?
I spoke a few days ago to a compliance manager at a leading global payments company, and he told me that this is a 20 years old company with so many different service providers already onboarded. And the truth is that he said that even if we decide to pull the plug on one of the service providers, no one at the company knows what the effect will be. No one knows which processes rely on the data from that service providers. Nobody knows which team is using the data. So it's very challenging even to retire a service provider because you don't really understand the impact on your business. So I think my recommendation is be mindful about the way you store and access data and heavily invest in a very detailed glossary and documentation in place.
Yeah, I mean, these things tend to be additive and have a certain amount of inertia, right? It's always easier to add more vendors or add more data sources and very difficult, as you point out, to deprecate ones that may not be, important or used anymore. What about you, Jeremy? Anything else to add here?
Yeah, I think it's very similar to pulling a superhero reference here is when if you take Iron Man or Ultron, when he goes through the phases of development, he destroys his previous self, and then you have his new being as being better than the previous one. Well, with most FIs, they're actually like Frankenstein's monster, where they're just adding layers of things that just you, in theory, like, oh, I'm going to do it this way. But then at the end, your finished product is significantly dwarfed. You don't really know what's going on. If you remove one thing, the whole thing collapses. So it's very hard. And when I was talking to several employees at a very large bank that went through a merger several years ago, they wanted to consolidate all of their AML, specifically their transaction monitoring data between both institutions into one. And as of just a couple of weeks ago, they're still going through that process. Probably, let's give them a grace year of not even handling the project, but they're now 3 years into it and they're still using two totally separate transaction monitoring systems, which makes it very, very complicated. Our duplicate alerts being hit because now you have all the accounts under one system, but are they triggering alerts on both of it? So you're creating redundant work. And I think from my perspective, as Alex also mentioned, is being able, whenever you do have a new data vendor, making sure that the mapping is done in a way of when you know what area it impacts. And so in the event that you take it out, you know the flow of information and how you're able to replace it.
I mean, I think that these kinds of challenges are only going to become, more relevant, prevalent as, bank and fintech M&A, potentially pick up steam, as companies look for exits or look for scale. And to your point, it's like, it's easy to say we're going to have all of these synergies and cost savings because we're going to, we're going to combine these things. But in reality, actually executing on that often, is time consuming, difficult, and expensive on its own. One final area that I want to dig into is addressing fraud across various payment rails. Here's a look at the top payment methods that are causing problems for fraud teams. Why do you think this is the case? Jeremy, if you can answer first.
Yeah. I mean, ultimately, consumers want fast, quick payments. I mean, I don't want to physically, I still absolutely hate when I have to go to my branch to wire funds. I think it is so, it's an hour-long process, and I have to do like, I have to make an appointment. It's terrible. If I could just do it on my phone and it would take me 8 seconds, wonderful. But I think that a lot of push has happened over the years, and I think COVID really accelerated that and forced banks and credit unions to adopt to these newer payment rails like Zelle, now FedNow, but didn't have the proper safeguards to prevent fraudsters from attacking their customers, which means that ultimately it's a damage. And now they're like doing damage control. They have this product that all their customers want, but their fraudsters also want it because it makes it that much faster to get their money.
I mean, that makes sense. I was at the Federal Reserve's FinTech conference last week in Philadelphia, and weirdly, a lot of conversation about crypto and blockchain. But when it came to payment rails, the launch of FedNow, I think brings great opportunity with it. But to your point, it also brings new risks to the banks that choose to build that capability and operate those faster payments, as well as end consumers who may not understand the differences in that payment rail versus something they're used to, like check, ACH, wire, whatever. Alex, does any of this come as a shock to you? Why or why not?
In general, I agree with your statement and in Jeremy's statement. At the end of the day, fast payment equals fast fraud. But we also need to look at what's going on globally. And I think we have a good example on how to implement real-time rails, such as Pix in Brazil and Interact Online in Canada, where they really making sure to balance between speed, convenience, and safety. And I really think this is the right way with real-time payments.
Gotcha. I mean, emerging technologies like the FedNow that we've been talking about, bring new capabilities to banks and fintechs and new products and services to consumers, but they are also incredibly likely, as we've seen in other jurisdictions, in the UK, particularly push payment fraud comes to mind. They're also likely to pose new fraud and AML risks as bad actors find novel ways to take advantage of them. In the final section, we'll cover the future of fraud and AML based on the survey findings. But before we move on to the final topic and then get to your questions, you should see a poll pop up on your screen. If any of these challenges hit home for you, consider a demo of Unit 21 to see how you can automate manual processes and easily access and integrate data to enhance your risk and compliance program. While we're waiting for the poll to conclude, I'd like to remind everyone to submit any questions using the Q&A button at the bottom of your screen. We will send the recording of this webinar to all attendees within the next day or so. Please feel free to share this link with your colleagues. Okay, let's move on to the final topic, the future of fraud and AML. Based on our survey data, 65% of respondents expect instances of fraud and money laundering to increase in 2024. This is no surprise to me, considering bad actors are constantly adapting and learning newer, more advanced ways of committing financial crimes successfully. With new financial services being introduced and adopted en masse, like P2P and real-time payment solutions, fraudsters are constantly looking to exploit these new technologies. However, another key theme from the report is that organizations want to move from fraud detection to fraud prevention and are having trouble doing so. Alex, can you explain why this is?
Unfortunately, many people during the pandemic realized something very simple, and that is crime pays. I mean, you can fairly easily make anywhere between $250,000 to $500,000 a year with a very low chances of getting caught. So if fraud is so accessible and so easy, why stop? And this is the main reason why we will see more fraud and more money laundering, because crime pays and people will naturally try to do that. But, moving from fraud detection to fraud prevention, it's really, it's a state of mind of, you need to understand why are you in the reactive state. And I think many financial institutions are in a reactive state simply because they don't put enough effort into preventing potential bad actors from joining their platform to begin with. And if you think about it, with the whole digitalization that the financial industry is going through, there's no longer in-personal relationship with a customer who walks into a branch. Everything is online. You heavily rely on your KYC and CDD when the account is open and created. But then again, we see over and over again that financial institutions will go through a KYC process. They will get so many different insights from the KYC vendors, which, by the way, made huge improvements in their offering in the past 5 to 7 years. But then that data is just sit somewhere in the database and it's dead. So nobody's doing nothing with the data they already got and paid for. And I think if you already allow the customer to join, allow the bad actor to join to your platform, you need to keep leveraging all those data insights into your continuous transaction monitoring if you really want to move from detection to prevention.
That really hits home. I mean, based on your assessment of the situation, is it fair to say that shifting this paradigm is critical?
Absolutely, there's no other way around it. I think onboarding KYC, CDD, and continuous transaction monitoring goes hand in hand. That's how you do it. There's no other way.
I mean, along this vein, the report noted that 47% of the respondents are interested in using consortium data or sharing data to help make this transition. What are your thoughts here?
I think the boom that we see in the consortium industry really reflects the fact that we are more focused today on first party fraud than what we used to 10 15 years ago. And this is the reason why our forward thinking customers joining and adapting our fraud DAO consortium platform, because at the end of the day that's a long game play, and I believe that early adopters will have huge advantage if they join the consortium in early days, and they will benefit from it in the future. At the end of the day, especially in the fintech industry, we are giving financial tools to many, many people, but it's our responsibilities as risk leaders to make sure that we're giving the right tools to the right people.
The last area I want to discuss is what it takes to build an effective risk and compliance program. 64% said leadership buy-in for the risk and compliance program was critical for success. Jeremy, what do these teams need to do to get buy-in and support from their senior management?
Well, typical buy-in usually also means that they're writing a check. So whatever you're doing to actually sell them on the idea of whatever your team is wishing them to have, you have to have a degree of understanding on what you're trying to convey and doing it in a way that makes them motivated. So having a good compliance team strengthens the overall business. It helps things run much more efficiently. So onboarding can go faster. Customers are going to start using your platform, and it's not going to be a honeypot for money launderers. And you avoid regulatory fines. So it really makes the basic risk management part of your being. And building out the compliance culture is something that needs to be sustainable and scalable, which means that when you're starting early stage fintech to all the way to a multi-thousand employee compliance or fraud practice, you need to be able to have a really strong core, because it's really bad when you're trying to get buy-in from senior management, but you have a dysfunctional compliance team. The last thing to mention is it could be a hiring tool. I think that it helps the organization's reputation in the broader market, so people will want to come for you. So you're going to have a lot better talent, or your talent pool is going to increase. And that's a major selling point to the exec team is having folks that you can entrust with the products and to make sure that it's running smoothly.
I mean, that really resonates. I've personally worked with a lot of different kinds of organizations or different points in their maturity, and having senior leadership, C-suite that is supportive of a strong functional culture of compliance, really is a key asset and differentiator. You can have all of the coolest vendors and tools and written documents, but you need to have the people that are behind it. Another high-ranking response was that investment into building a culture of collaboration, with 60% saying that this was important. What are your thoughts there? Do you have any advice?
Yeah. So one call out is that I have a connection on LinkedIn that hates the usage of the word Framel. So I'm going to say it a couple times for him, Framel, Framel, Framel. But I don't typically like to use it either. However, the data that is used for investigations or rule creation can also be used on the AML side and vice versa. So I think that it should be, you shouldn't just exclude data because, right, you have to have a purpose. And most of the time, if you're receiving the data for some type of fin crime prevention, it's going to be useful on both teams. So you shouldn't be working in silos, or the data shouldn't be just theirs. IP addresses are important for both sides. Device IDs are important on both sides, and it's not just a fraud function, right? And collaboration on Slack, Microsoft Teams, or whatever you end up using for your inter-department communication, can also get the conversation going. And so even if it's a summary of an event or article, a movie or TV show that you really like that has subject matter relating to AML or fraud, being able to have those discussions gets the mind going, but it also gets team dynamics as you're able to create personalities and sharing. And when I was an AML compliance officer, I loved being able to share articles, but also one tip that I would recommend, instead of just like copy and pasting and people may or may not react to it, write a very, very quick summary to highlight why it's important, why it's impactful for your organization and maybe the industry.
The third most essential component of a successful program is having reliable transaction monitoring and case management software. What does that mean to you, Jeremy? What should AML teams be looking for here?
So, as I mentioned in what I just said relating to data, I think that does your system leverage all accessible data that's useful for your investigation? How easy would it be to switch providers of a specific data point like IDV or sanctions? Uh, how easy is it to fine tune rules, whether it be complete alterations or just changing the dollar thresholds or adding an additional data point? Does your solution have AI and ML features? And if it does, is it vaporware or is it actually going to improve your organization? Does it scale with the team and headcount if transactions change or the risks change from increasing very high, but in the event that things get low and you have a reduction, are you able to fine tune those things without a very cumbersome process?
What do you think, Alex? Is it different for fraud teams?
I think what Jeremy just described is very accurate, and I completely agree with him. Um, and you don't have to like the term FRAML, you don't have to use it, but what you really want to have is a collaboration between the risk and compliance team and making sure that they have one environment where they can share the insights of their work. But really, at the end of the day, the tool that the team uses must empower the team. That's it. It's as simple as that. Fast and accurate investigations, making sure that your reaction cycle from the point you detect a new fraud and how do you deploy the solution for it is very, very short. And that's it. Keep it simple.
Well, that about wraps up the discussion for today. Thank you so much, Jeremy and Alex. That was a fantastic program. Everyone who registered will receive a copy of the report once it launches. We hope you've enjoyed the sneak peek into the survey results. We do have quite a number of questions, so let's see how many we have time to get through. So I'll go ahead and start with the first one. As user data is a major part of fraud mitigation, how can we be proactive in collecting as much data as we can when consumer data privacy is getting stronger? And I think, Alex, that sounds like a good one for you, given the fraud mitigation focus.
Yeah, absolutely. So I don't think we need to collect as much data as we can. We need to first understand what data will be useful for us in order to provide a better protection for the customer. And that's it. There's no point of collecting huge amounts of data and then not using it. So really make sure that you understand which data points you need from the customer journey either from onboarding or from the historical activity or transactional activity of the customer, and then make sure that you safely integrate that into your fraud prevention and compliance vendor to really making sure, like you said, you stay compliant and making sure you don't breach any privacy regulation.
Jeremy, do you have any perspective to add there as far as collecting data? How much is too much? What is the right amount? Are there trade-offs there?
I think Alex was right. I mean, ultimately, you want to get the least amount of data that you can, but also leverage it fully. So you don't want to have meaningless information that is just collecting dust or is just essentially a ad revenue for the customer or from the vendor you're buying from, but you want to make sure that it's just meaningful.
That definitely resonates and makes sense and is true in the space that I come from in credit as well, where you can talk about having 10,000 or 100,000 data points, but the reality is a small handful of them tend to be the ones with the majority of the explanatory power. Okay. The second question, how does your product create efficiency within the operations banking department? Jeremy, can we start with you for that one?
Sure. Yeah, I think that there's a couple of ways in comparison to other vendors. A couple of enhancements that we've done is workflows and entity-centric investigations. So instead of handling alerts that are based on transaction or events, if there's several alerts that would be populated with one person, then you're able to focus on just aggregating those alerts under one person instead of handling it as they come in. Another great thing that we have at Unit 21 is graph-based rules or link analysis, network analysis, which when you're going through your case investigation, you're able to see links of data with your independent customers that might end up having shared data so that it will help out and also streamline an investigation. So maybe someone that you had no idea was part of the fraud ring. Now through link analysis, you see that they share IP addresses, which is and maybe a home address. Maybe that person is an innocent. They're just a roommate. However, when it comes from the FBI's point of view, the more context, the better. So it's just an additional door to knock on for them, and it really helps out a case.
Got it. Alex, do you have anything to add there?
No, I think what Jeremy shared is very accurate. At the end of the day, for me, I really love the way we look at entity-centric investigation, really not focusing on the transactions that we flagged as risky, but rather looking at the whole holistic view of the entity and how it's been interacting on our platform historically and with other users utilizing network analysis and graph-based rules.
Okay. Next question, are you using blockchain at all? In my understanding of this question is as part of the Unit 21 product or capabilities.
Yes.
Yeah, go ahead.
So the really nice thing about Unit 21 is having us being data and vendor agnostic is you're able to leverage data that you may be getting through those third-party solutions, whether it be chain analysis, Elliptic, TRM Labs, Merkle Science, whatever the case may be. You're able to use possible risk scores associated with a transaction or a Bitcoin address and be able to use that within Unit 21.
Got it. Alex, any additional context?
I think at the end of the day, the beauty about Unit 21 is that we don't enforce you to go in a specific direction. If you feel that you can leverage blockchain data as part of your business needs, we can, like Jeremy said, we can integrate that into Unit 21.
Got it. Okay. The next question, number 4. Do you carry the risk rating from account opening to the transaction monitoring software? Do you produce more alerts for riskier applicants? Jeremy?
Yeah, so we have a way of doing it right now, but we're significantly increasing what that's going to look like in the future. So right now we have ways of addressing customer risk or customer risk segmentation by tagging. So you can do low, medium, medium, high, PEP, whatever the case may be. You can tag those people at onboarding and then adjust certain rules to either only apply or be applicable to those customers. But what we're really excited about is the enhancements from that, which is going to be, as the question stated, something that you can do on an onboarding, but then also through their transactions within your system. So it's not only transactions. Sorry, to retreat on my previous statement. It's transaction and non-transactional events. So it's behaviors, but also patterns that typically will showcase high risk activity within your customers.
Got it. Thank you for that. Going to the next question, number 5. Was there any discussion around the adoption of machine learning slash AI to address real-time fraud for these real-time payment systems? Is that something that's been a topic of conversation at Unit 21? I see you nodding, Jeremy, so why don't you answer for us?
Yeah, it always is. I mean, it's been a hot topic within the industry and always a hot topic within Unit 21. As I mentioned earlier, is I don't think that we, at least right now, want to use our AI and ML feature to do case disposition. I think we just want to improve the way that cases are handled, being able to leverage alert scores to say, focus on this. But then through our product enhancement, we also wanted to do rule tuning suggestions. So based on previous activity, this is the rule that hit the alert, and these are the true positives that come from it. Well, maybe you should add this additional data point that ends up making this rule that much more specific, so you're able to focus on your more true positive and remove a lot of the false positives.
Got it. Next one, I think, will be for Alex. How can you identify and minimize authorized push payment fraud? So again, this is something that definitely has been a problem in the UK, and with the the rollout of FedNow and of course Zelle, etc. Increasingly seems like it's going to be a problem in the US. Alex, any advice for our questioner?
Yeah, authorized push payment, it's a big pain and it's really hard to flag, let's put it that way. And I think preventative measures should be more around education and awareness, and also really think about the way you built in-app friction. So I think we all understand that there is when a customer accesses their bank account, there's almost like a unique key that represents the way they access it. The problem with authorized push payment is that that key looks valid and legitimate. So whenever we see an access to the app, and we recognize that the payment, that outbound payment might be to a new payee, we need to understand in a smart way how we can introduce friction before that payment happens, in order just to make the customer for a split second stop and think, am I really sending the funds to the right person for the right reasons?
Got it. As a user, I've definitely noticed that in some of the services that I use. Jeremy, next question for you. How can we get leadership buy-in when there's not significant fraud loss or fraud problem, but the fraud tools we're using are outdated?
I think the question would be answered through efficiency, and also, as the military typically wants or puts it, is that you want to have a preventative measures in place now, and not when you need it. So it's a way of scaling your department in the event that there's a doomsday event, and you don't want to have a fraud product. Shopping for a fraud product during a fraud event. But the easier, or I think those two conversations are great. Driving for efficiency, trying to measure how long does it take for you to do this process? How long would it take for this? So if it took you an hour versus using a solution, it will take you 5 minutes, 55 minutes of savings times whatever the amount of salary or your hourly rate. And there you go, multiply that versus the amount of alerts or cases that happen throughout an entire year. And you can come up with some form of rough calculation. And then on top of that, I think that with fraud, you're wanting to be preventative. So you don't know when the next fraud event is going to happen and when it's going to happen. I was just listening to something because Alex referenced it on LinkedIn about auto loans being a huge area of boon for synthetic ID fraud. I guarantee they weren't thinking about that. What's that online car purchasing company? Probably wasn't on top of mind. They were just worried about selling cars, right? And they're like, well, why would a fraudster want to get delivered a car to their house? They don't care. They're going to be driving away and then trying to either they stole a car or going to resell it for cash. So, yeah.
Got it. All right, I think we have time for two more. Alex, this one's for you. Can linked network risk ratings be incorporated into application and or authorization processes via models or rules?
So in general, I think the answer is yes. And if you think about it, and this is probably me wishful thinking, but let's say we have a wide adoption of consortium products in the industry. The way I see a good consortium product in the future is that you can actually put it before your KYC process even starts. And before you even spend money on authenticating the person who tries to onboard to your platform, take a sneak peek at what others can tell you about this entity. And if there is a high risk, associated high risk with that entity, maybe you shouldn't even start the onboarding and actually save some money.
Got it. And last question for today for you, Jeremy. How can we define the correct KPIs for business in order to avoid risks in the future? What do we need to consider? So I assume that would be specific to the fraud and AML risks that we're talking about.
Yeah.
What are the right KPIs?
I think it's pretty hard to distinguish. I think it's going to be done by business unit. I think that I'll probably lean on an answer from Alex's from the fraud perspective. But on AML, if you have an organization that pumps out 1 million or 1 billion worth of transactions a year, and you have 10 SARs, I think that's probably pretty low. You do have to follow your risk assessment. You need to understand where your risk vectors are. And I would say that there needs to be some level of, unless you are the perfect bank or perfect credit union, perfect fintech that only has perfect customers, then you won't have to deal with filing SARs. But that's wishful thinking. And ultimately, I think that's more likely than not that a new Marvel movie will actually be good versus you not having to file SARs.
That sounds like a great place to leave this conversation. So that's all we have for today. Everyone who's listening and watching at work, at home, thank you so much for joining us. Alex, Jeremy, thank you so much for your participation and expertise. If we did not get to your question, we will follow up with you directly. If you'd like to learn more about or subscribe to FinTech Business Weekly, you can find it at fintechbusinessweekly.substack.com. And if you'd like to learn more about Unit 21, please visit the website at unit21.ai. Thank you again for joining us for today's discussion and enjoy the rest of your day. Thank you.